I'm Dennis Brager. I'm a former IRS trial attorney and as California State Bar Certified Tax Specialist. This is one in a series of videos designed to give answers to questions that my clients frequently ask. Today we'll be answering the question, what's the difference between criminal tax penalties and civil tax penalties? Well, basically, just like it sounds. If you commit tax evasion or tax fraud, the IRS can prosecute you and send you to jail. Generally, most tax crimes carry a maximum 5-year prison term and a fine of $100,000. The same conduct which constitutes criminal tax fraud may also be considered civil tax fraud. It's up to the IRS whether it wants to impose criminal tax penalties, civil tax penalties, or even both. Civil tax fraud can't send you to jail. However, it can result in a penalty of 75% of the tax due plus interest. A little reminder here, just because criminal tax penalties are imposed, that doesn't mean civil tax penalties won't also be imposed. In fact, in most criminal tax cases, a convicted defendant will be required to pay civil taxes and penalties as well as criminal fines. While the conduct that supports both criminal tax penalties and civil tax penalties can be the same, the IRS is held to a different standard of proof. In a criminal tax case, the IRS must prove tax fraud beyond a reasonable doubt. To impose a civil tax fraud penalty, the IRS must only prove tax fraud by clear and convincing evidence. These standards have been defined in slightly different ways by different courts over the years. Generally, however, clear and convincing evidence is that level of proof showing that a fact is highly or reasonably certain. That's more than a preponderance of the evidence, but less than beyond a reasonable doubt. Beyond a reasonable doubt is the highest standard of proof known to the law. It does not, however, require absolute certainty. A reasonable doubt is one which is not imaginary or frivolous. Tax fraud, both civil and criminal, requires the voluntary, intentional violation of a known legal duty. Let's unpack that a little bit. What does all this mean? First, you must have a legal duty to take a certain action. For example, most people are required by law to file a tax return every single year. That is a legal duty. However, if your income is below a certain cutoff amount, which for 2016 federal income tax returns was $10,350 for a single individual, then you had no legal duty to file a tax return, and therefore you could not be said to have committed tax fraud or tax evasion because you didn't file a tax return. Even if you didn't file a tax return when you were required to, for there to be tax fraud, it's not enough for the IRS to prove that you had a duty to file the return. It must also show that you knew that you had a legal duty. There is an old expression that ignorance of the law is no excuse. While that's true in certain circumstances, it's definitely not true in tax law. Ignorance of the law may be a complete defense to a conviction for tax fraud. The U.S. Supreme Court has made that very clear in a case known as Cheek versus United States, which was decided all the way back in 1991. John Cheek was a tax protester who failed to file tax returns from at least 1980 through 1986. The IRS put him on trial for tax evasion. Cheek represented himself in court and explained his belief that income taxes could not be imposed upon him because he didn't believe his wages were taxable. He was convicted by a jury of several counts of willfully failing to file a tax return and willfully attempting to evade tax. The Supreme Court, however, held it was a mistake for the judge not to allow the jury to consider Mr. Cheek's beliefs that his wages were not income and that he was not a taxpayer within the meaning of the law, even if those beliefs were not objectively reasonable. Cheek's conviction was therefore overturned. However, the Supreme Court did point out that the more unreasonable an asserted belief is, the more likely a jury will not believe that they were honestly held. Let's take an example. Let's assume you own an import-export business which imports industrial control systems manufactured in China. You set up a trading company in Hong Kong which hires an unrelated manufacturing company in China to design and manufacture the systems. Your U.S. company pays your Hong Kong company $50,000 for each order, which you sell in the United States for $60,000. The Hong Kong company pays $40,000 to the manufacturer. In turn, the manufacturer transfers $15,000 to your personal account in Hong Kong. Assume this happens about 10 times a year. You now have several problems, including, but not necessarily limited to, number one, you will be required to file Form 5471 for your Hong Kong company. 2, you need to report the profit of your Hong Kong company on your personal federal income tax return and pay taxes on it. 3, you will be required to file Form 8938. 4, you will be required to file a foreign bank account report, known as the F-bar, on FinCEN Form 114. Whether or not you may have committed either civil or criminal tax fraud will depend upon whether the IRS can prove that you knew you were required to file the various forms and that you were required to report the income in question. If a jury believes that you were unaware of the various forms that were needed to be filed, then willfulness does not exist. On the other hand, it would be less difficult for the IRS to prove that you knew you had to report the income you transferred into your personal account on your income tax return. Still, depending upon a person's education level and other factors, a jury might believe an argument that, for example, you believe that the income earned overseas was not taxable in the United States. If you found this video helpful, please let me know by leaving a comment. And if you would like me to update you when I post a new video or send out a newsletter, please send an email to zlaviste@bragertaxlaw.com. Thank you for watching my video and have a great day.